every loan a bank gives, we ask for any collateral security. Collateral security we ask. Why? Because we know that if the loan is defaulted by the borrower,
Sir, kindly go to all.
Sir, I muted, sir.
okay.
Sir, can I mute all?
What I can say, suggest. See, after requesting also, people are not listening. They are all adult people. All adult people, they are working in a financial organization called bank, and if they do not maintain the discipline, then what I can say?
No, okay, sir. Okay.
So kindly mute, sir. We have been requesting this. If every time our time is also precious, so we are giving time, sir.
Everybody's time is precious, not your time. Do you think my time is not precious? Everybody's time.
Your time is more precious, but we all are investing. And we have been requesting in the past also to kindly mute all, sir. Whenever they have any doubt, we'll ask permission and then we'll ask the question.
Okay, fine. Let's see. Okay, suppose a loan of 100 rupees is given to somebody. Normally for such loans, any loan which is given by bank, we always prepare ourselves by obtaining some type of collateral security to secure the loan, so that in case of default, means a borrower does not pay, we will be not put into the loss totally. So that is, suppose 100 rupees loan I am giving. So I know that if the borrower does not pay, 100 rupees loss will be there. So it is estimated that 100 rupees might loss. So to secure that, at least I will ask the borrower to give a security of bank will ask that at least you give 100 rupees as security, or more than equal to or more than 100 rupees of security before disbursing the loan, so that we can say that our loan is secure. So when we know that this much of loss will be there, then we are preparing ourselves with some kind of provisions or some kind of arrangement of collateral security to avoid the loss. So for expected loss, we can prepare ourselves, or we can make some kind of arrangement so that loss can be prevented. But in case of unexpected loss, we do not know how this loss will happen, when it will happen, and how much loss will be there. In such cases, how can we prepare ourselves? We cannot prepare ourselves to prevent that loss. So basically, to cover this type of unexpected loss, the capital is more important. Capital comes into big help or comes into assistance to absorb this kind of unexpected losses also. Basically, unexpected losses, what are those losses? Losses due to operational risk. We'll talk about that later when we talk about different kinds of three major kind of risks. So operational risks are those risks where we cannot estimate the amount of loss. It is not possible. Other than operational risk, credit and market risk, it is possible to measure the loss. But in case of operational risk, it is not possible. Credit risk also somewhere it is not possible. Market risk also not somewhere. Some part of market risk is not possible. So basically what I mean to say is that capital is going to help to prevent the unexpected loss. So it will be very useful to cover the unexpected loss, because For expected loss, we are making some kind of arrangement like collateral security or making some provisions, keeping aside the amount from P&L to make it ready so that when it is written off, we can easily make it compensate that. So that is the link to the capital. So basically, main link is between unexpected loss and capital. So we are strengthening the capital so that in case of any kind of unexpected loss which might happen in future, that can be absorbed by the capital so that we can avoid the bankruptcy. Okay, so this is the basic thing in type of loss, expected loss and unexpected loss. Okay. Now coming to risk management. Why risk management is required? By now you should have understood that why risk management is important in financial business or financial organization. Because unless we manage the risk, we cannot prevent the loss. If loss is not prevented, continuous loss will happen and we may face bankruptcy. For that purpose, risk management has got the prime importance. And we have also known that what is the impact of uncertainties in the cash flows? How these cash flows are impacted by uncertainties. Uncertainties, cash flow. How the cash flows are impacted by uncertainties, which leads us to the variation in net cash flow. We have understood that. So this net cash flow can be either favorable or it can be adverse. So the possible adverse impact is called, what is called? The possible adverse or unfavorable impact in the business is called?
Loss.
Risk.
Risk in the business. Risk in the business. Okay. So that possible adverse impact is called risk in business. And always remember, this unfavorable impact of uncertainties or the risk in business, this is not constant. This is not constant at all. Or this is not a fixed magnitude. It varies. It varies. It might be low, it might be high. So you cannot predict that it is a constant factor. So if I keep 100 rupees, it is okay for me. No, it is not a constant or of fixed magnitude. It can and it will vary depending on the degree of severity of the adverse variation of those uncertain factors which are impacting the cash flows. So if there is a huge loss, huge losses will lead to erosion of capital and eventually will face bankruptcy. Because continuous losses will be there. If that continues, capital has to be wiped out because you have to compensate that loss with the capital only. So when the capital is going to be completely wiped out, you are heading to bankruptcy. Okay, suppose, for example, I just give a simple example. Suppose somebody is doing a business in the season, say he is buying mangoes from the farmers and selling it in the market. So in the mango season, he buys mangoes and sells in the market. Suppose that person has bought, say, 500 kg of mangoes, 500 kilo of mangoes, say at a cost of, say, 20,000 rupees. So 20,000 capital he has invested and he has bought 100 kg mango and he is bringing it to the market to sell it. But due to some misfortune or some mishap on the way, the vehicle which was carrying the mangoes, it met with an accident and it was damaged and almost all the mangoes were damaged. So what has happened? He has lost entire capital of 20,000. So his capital is gone out. Totally, he's lost his capital. So there is a risk. So that risk was not covered, for which he lost his capital. So he should have done something to prevent the loss of his capital. So what would have been done? What might be the thing he should have done to prevent that capital not to be lost?
Packing mangoes in the safe box.
Very good. So basically, insurance is the one thing he should have done it. While carrying the mango from this, some insurance premium he should have paid, so that in case of loss, at least his entire capital would not have wiped out. Maybe he should have got back, say, 16,000 or 18,000 claim, he should have got it back. So he should not have lost the entire capital. So that is called risk management. So there is a risk. How you are going to manage the risk so that you are not losing your entire capital. That is called risk management. Therefore, risk need to be managed, because you cannot eliminate the risk. Once you have jumped into the water, into the swimming pool, there is no way that you cannot swim. You have to swim. Before jumping, you can avoid the risk. But once you have jumped inside the water, you have to face the risk. You have to swim. Otherwise, you will drown. So, risk cannot be eliminated when you have entered into that business. So, risk has to be managed. That is why the risk management is so important. Risk has to be managed. So, we have understood all these things. I have told you about all these things. So, to save the bank from bankruptcy, the loss potential is the maximum loss which might happen. That has to be controlled. For that, risk needs to be managed. And these loss potentials are the cost of the business. That is the risk. Due to risk, this loss happens. They are called loss potential, and they are the cost of business. So you have to control that cost of business to stay in the business. Okay. So loss potential of a business is correlated to the risk in the business, which has to be managed efficiently. That is the basis of risk management. Why risk management is done. Okay. Now, when you come to the definition of risk management, so we can say that risk management is the process of assessing the actual or potential danger, or we can say this is potential loss. Okay. Instead of dangers, we can say loss. Risk management is the process of assessing the actual or potential danger or loss of a particular situation in that business. So basically that means what? That means the risk that need to be managed is to control the losses in such a way that it would not wipe out our capital, which have been employed by us to do the business. Because if capital is wiped out, we are falling into bankruptcy. So such businesses, such adverse situations can only be avoided if the loss potential of a business can be controlled. Okay, so this is the risk. So measures of loss potential is critical, or measuring or assessing the loss potential is very, very important or critical, as it helps to arrive at how much capital is required for the business. Because we need not carry the full amount of it. Suppose we are giving loan of 100 rupees. Suppose it is secured by 100 rupees of security. So today 100 rupees loan is given, and a security, say any kind of land or investment or any kind of security is there, that does not mean that we can say that we are secured fully here or there is zero risk here. No, it is not possible, because loan is given 100 rupees. So he has to pay back. If he defaults, then definitely interest are charged on the loan. So a loan amount will go up eventually. And the security which is there, it might also depreciate in future, unless it is a land or house. Because land and house or gold, they do not depreciate. Other than that, everything depreciates. So there is a possibility that there will be depreciation on the security, and the loan amount may appreciate due to application of interest. So that means our assessment of zero risk is not correct for any kind of loan. So we can say that the risk might be, say, 20 rupees here, maximum 20 rupees. So such cases, we can say that for 100 rupees loan, if you carry, say, 10 rupees loss, suppose we can say that 10 rupees might be loss. So for 100 rupees loan, it is not required that you have to maintain a capital of 100 rupees. It is not required, because we know we have some security. So maybe if we keep 10 rupees capital, that is possible to avoid the loss. So that is what this is called. So measuring the loss potential is very, very important, as it will help to arrive at how much capital is required for the business. Because maintaining capital is not an easy factor. Bringing in fund from the public as a deposit is a very cumbersome procedure now. It is very competitive world. You cannot ask the depositors to bring in more money. So where from the capital will come? Capital comes from the profit, and we are every bank is struggling to have a profit. So maintenance of capital is not a free of cost thing. It has a very high cost, because unless you have profit, you can manage. So how much capital is required? That's why it is called minimum capital requirement. What is the minimum capital requirement? That has to be provided by the bank. Okay, so this is the concept of risk management. So loss assessment due to risks to be accounted for by treating risk as the cost of business. And we have understood that the loss potential are the cost of business. So according to that cost of business, we have to assess the risk, and after assessing that risk, we can assess the loss, and according to that loss, how much capital is to be maintained, that has to be made ready. So these are the basic thing about this thing. Okay. Another thing we should also understand in risk management, entire risk management, when we calculate the capital, everything is assessed in a statistical manner. Okay, so basically 2-3 terms are there where we have to be very careful. We have to understand those things to calculate what will be the requirement of how much capital. So basically how this risk concept is measured, that we should understand. So basically, I will say, just explain that there is a thing called probability. Probability. Because risk is uncertainty. So everything is there, probability. So risk means either there is a gain or there might be a loss. Both are either or. It is not sure that you will have a profit or you have a loss. It might be possible that you may gain or you may lose. So that's why when it is uncertain, so we can use the term probability. So for each type of business we do in the financial world, we have to assess what is the probability of loss. So probability means it is about the loss probability. Second thing is, what is the impact? Second thing is about impact. So impact means impact of the loss. Means impact is expressed in the amount. we can say, we can assess or we can arrive at the amount of loss. So that is called impact. Probability of loss means what is the chances? What is the chances that we will face loss? So we can give this probability and impact some kind of score. One kind of score we can say, or percentage or score, whatever. So we can say that 100% chances means it is sure that it is going to happen. 0% means it is not going to happen. Similarly, so we can give a score or we can give a rating. Say 0 to 1 rating, 0 to 10 rating. 0 means, probability 0 means it is not going to happen. And impact means how much it will happen. So when the probability is 0, you multiply it with impact. So impact is, suppose we say impact is 1. Then we can say the final score can be probability into impact. So it will be 0 only. Are you understanding what I'm explaining here?
No,
Yes
sir.
or no?
Sir, please once again, sir. Once again.
Okay.
Yes,
Okay.
sir.
I'll give one example so that it will be easier to understand. Suppose you think of an animal called tiger. Okay. Tiger is a very ferocious and dangerous animal. Suppose you come across tiger face to face. Face to face, you come across the tiger face to face. आमने सामने हो गए आप. Totally like say within 1 feet or 2 feet distance. So what is the probability of loss of your life in such case? If the score is 0 to 10.
99%.
100%.
100%.
99%.
Okay, so in that case, if the score is given 0 to like 10, 0 is the minimum, 10 is the maximum, what will be the probability of loss?
9.
10.
9 or 10?
10.
So who has told 9?
Myself, Praveen.
Praveen, what is your muscle size?
Normal human being.
Normal human being. So how you have given 9? Everybody is saying 10. You have given 9. I thought you might be a giant like lion or something like that. So you can fight with tiger. Anyway.
The
No, sir,
tiger
it
might
is not
go
hungry,
away.
won't
He
eat.
might not be hungry.
Oh, might not be hungry. See, hungry means, see, animal, if they are hungry, they kill for eating. But if they are threatened by somebody, they will attack you to save themselves. So if they are not hungry means they will not eat. How many tigers you have met, brother? Okay.
So
So
1% will be of God's grace.
oh, God. So for appearing in CIB also, there will be some grace by the God. God helps those
Well, this time we
God.
don't have any negative marking. So maybe
So negative marking was never in CIV. Never in
next time onwards
CIV. No.
we'll have.
So if you pray to God, God will never listen. God will say, if you prepare, you are going to pass. If you do not prepare, you only give a agarbatti and flower and coconut to me. That bribe I will not accept. You will fail. Okay. Okay.
Yes, sir.
Okay. Finally, for this tiger, so probability is how much? 10. Okay. Probability of loss of life is 10. Okay, so you are meeting the tiger in a say road. You are going in a some kind of highway or something, and there is a forest. So tiger comes. So you are just came down from a car, and suddenly tiger comes. So there is a probability that you will be killed. 10. So probability of meeting the tiger in that thing is 10. Suppose if he comes now, if he kills you, if it is hungry or he is feeling threatened, what will be the impact then? Will you totally die or you'll be saved by the grace of God?
Will be safe.
You will be saved. Okay?
Yes,
You will
sir.
be saved, na? Somebody has told saved. If you are saved, then how much impact will be there? How much impact will be there? Huh?
Zero.
Zero.
Zero. You are saved means zero. Saved means life is saved, but some injuries might be there, na? Or just tiger will come, oh, so Mr. So-and-so, oh, your exam is in November, na? So I am not eating you. You first pass the examination, then I will come eat you.
No, sir.
Then
Impact will be
tiger
10, sir.
There will be some
impact.
effect on our bodies.
So impact will be also 10 in such a
Yes,
situation.
sir.
So that
Yes, sir.
means our score will be 100. Maximum loss will be there. Okay. So this is a situation where you are facing the tiger in a, say, in a road or somewhere in a forest nearby. You are going back in a highway or something. Suppose you have gone to a zoo. Suppose in case of you are visiting a zoo. What is the probability loss will happen when you visiting a zoo? What will be the chances that the tiger will come out of the zoo and you will be facing the tiger? What are the chances?
Zero.
One.
Zero.
Zero, sir.
Zero.
0%.
Can you say that with your it is zero?
50%, sir.
0 or 1, sir.
0 or 1 or somebody is 5. Say we can say that 3 or 4. We can say 3 or 4 chances, because sometimes some mishap might happen. Somebody might not have the zookeeper might have not have closed, or the tiger might have jumped the boundary. Something like that might happen. So you cannot say that it is 0. It might be. It is definitely not 10, but it might be 3. But if the tiger comes, at all comes, the impact is always 10. Impact is always 10, because when it happens, that loss is have to be taken into care of. Loss will be always full loss, because if the tiger comes in front of you, it is going to eat. So 10 will be the loss. But chances of or probability of coming of the tiger from the zoo is very less. So in this case, what will be the score?
0.
30. Probability into impact equal to score. Okay, so here it is 30. Suppose third case scenario. You are roaming around the city, say Bangalore. Bangalore, you are going to office from your house. What are the chances that a tiger will come on the road?
0.
So we can say that this is 0, because there is very unlikely a tiger will be coming into the city like Bangalore. It is not possible. But impact remains same, because tiger when comes, it is going to eat you. So here score will be
0.
0. So that means according to situation, how these situations are there, we decide the probability of loss, and impact is also same. If it happens, then what will be the loss? So, and the final score will be probability multiplied impact is equal to the score. So in case of a forest or highway, there is a 100% risk when you encounter a tiger. So you are going to be his dinner or lunch or breakfast, whatever it may be. But in case of a zoo, the risk level comes down to 30%. From 100%, it comes to 30%. And a city like Bangalore, Delhi, or Bombay, unlikely the tiger will come. So it can be 0%. Now it is understood. According to situation, what type of loan you are giving, what will be the probability and what will be the impact, and what is the amount total score will be. This score, we can say this is the risk weight score.
Sir,
Okay.
Sir, the impact can be losing a hand or a leg or eyes. Then will it be the 100% impact, 10 out of 10, or losing a hand can be impact of less than 10?
No, then it will be less. Nah? In that case, it will be less. I am talking about, say, I am taking the extreme loss. I should be prepare myself for the extreme loss. Why I should say that only one finger the tiger will eat? I should be prepared for that. Nah? I am giving this example. This is not a real case.
Yeah,
So
I have
you relate so to make you understand. I have given this example. So in such cases, in case of finance or loan or in banking, you relate to that. Your question is very logical question. So impact may this I have taken into consideration that total loss. So there might be a loss of hand or loss of leg or eye or something like that. So in such cases, this 10 will be less. We can say 5. So in this case, so 10 into 5, it will be 50. So risk level comes down. So you have to relate that how much loss you are facing. So according to that, impact level will go up or go down. Okay. Is it clear now?
Yes, sir.
Okay. So this is what the risk weight. According to such situation, any loan or investment the bank makes, each and every loan and each and every investment is made, a risk weight is assigned according to the probability and impact, and risk weight is assigned by the regulator. RBI has assigned risk weight for each kind of loan you give and each kind of investment the bank makes. It is totally constant. Risk weight has been assigned. This has been assigned by RBI. For this loan, this is the risk weight. That means suppose risk weight is given as 100%. That means what? This means what?
Security we want 100%, sir.
We have to make provision 100%.
No, this
Unsecured, sir.
Unsecured loan.
Unsecured, sir.
I am not asking about what is the capital required or what is secure or not. I am just asking if the risk weight is 100% means what?
More probability, more probability of 100% loss.
Probability of loss is 100%.
So it is likely. So this means it is 100% risky. So there might be 100% loss. Simple. We are not talking about capital now or collateral, nothing. So if the risk weight is given as 50% means
50% loss.
50% risky or 50% loss. So if the risk weight is say 20%, that means it is 20% risky, 20% loss. A 20% loss means 80% we are safe. Here 50% we are safe. Here 0% we are safe. So if the risk weight is given 0% means there is 0% risk. That means we are 100% safe. Okay.
No loss.
So this risk weight concept is clear to you?
Yes, sir.
Okay, fine. Then we can go ahead. Okay. Any question?
Sir, again, please pardon, sir.
Again what?
Sir, I did not get it, sir.
Why you didn't get it? What I spoke in English only. There is a simple thing. I have. Did you understand what is risk weight is?
No, sir. No, sir.
No means you are not listening to me last 10 minutes.
Actually,
last 10 minutes I have. What actually?
Sir, actually listen, but this last actually I did not get it, sir.
Last means before last I have explained risk weight. Tell me what you understand by risk weight. I was explaining probability, I was explaining impact, I have explained score, and this score I explained that this risk weight. So what do you understand by a risk weight? Tell me.
Okay, so got it.
What you got it? Explain to me. You tell me. You tell me.
As a probability and impact, is total thing is risk weightage.
That means what? Risk weight means what? Suppose I say it is the risk weight is 50%. That means what? That means what?
Means
yes, explain what you say. You may make mistake. Unless you make mistake, you cannot rectify yourself. You tell. Do not hesitate. If you want to understand the concept, you have to make mistake. You might be right also. You explain.
Means probability is 50% and the impact is also 50%.
Nice. This score is risk weight. So this into this is 50. Here score is risk weight. So probability and the impact together it is 50%. So that means what? In financial business, if risk weight is given as 50% means what? What do you understand by this? Suppose risk weight is given 100%. What do you understand this? Risk weight is given 20%. What do you understand by this?
Sorry, sir. I cannot explain this, sir.
You cannot explain because you are not listening to me. Okay. So if you listen, focus. See, this is a class for 1.5 hours. 1.5 hour focus you can maintain, easy to understand. Okay, I'm explaining. 50% risk weight means this is 50% risky and 50% safe. Now it is clear?
Yes, sir.
So if it is 100% means 100% risk weight. Yeah, tell me.
100% is safe.
100% is
risky.
100% loss. 100% risky.
No loss.
No loss.
100% risky.
100% risky.
0% loss.
0% safe.
0%
See, here it is 50 risky, 50 safe is written. If it is 100 risk weight means risk, how much risky it is?
100% loss.
I am not talking about loss. We are talking about a risk. Okay.
100%
Loss,
risk
what will happen?
100% risky.
100% risky, 0% safe.
0% safe.
If it is 100% risky means rest amount is 0% safe. So 20% risk weight means 20%
20% risky, 80%
80% safe.
Simple, a class 4 student can understand this. How you are not understanding this? Okay, so it is clear.
Got it.
So now the main point in risk management is that controlling the level of risk. So we have to control the risk. So controlling the level of risk to an organization's capacity to bear the risk is the essence of risk management. That means what? How much risk level can be controlled by any organization according to its capacity. That is the essence of risk management. That means a small bank versus a big bank. Say big bank, say we can say SBI. Small bank, say we can say Federal Bank or any other small bank. Small bank, Federal Bank. So versus SBI. So capacity of Federal Bank to control the risk will be definitely less than the capacity of a big bank like SBI to control the risk. So controlling the level of risk will be differing according to the organization's own capacity. Because according to that, they can bear the loss of risk, loss due to risk. So the risk management theory or procedure or risk management policy will be different for a small bank and it will be different for a bigger bank. Okay, so That's why risk management is the process of assessing the actual or potential dangers of a particular situation depending on the organization's capacity. Okay, so this is the essence of risk management. Now we'll see what is the risk management framework in a bank. Every bank has got a framework where the risk management is situated in the head office, how they are working, what is the setup of this risk management in a bank. So basically, risk management is so important for each and every bank. So risk management is a major concern for the top management. Top management's major concern. It is top management main concern because they are taking care of the entire bank. So they have to devise the policy, guidelines, instruction, circulars, everything will be designed by the top management only. They will set the risk limit. Risk limit means how much risk a person as a branch head can take. Risk limit based on the economic measure of the risk, a person will be given power to how much he can exercise the risk. That's why a scale 1 branch manager, scale 2 branch manager, scale 3 branch manager, like this scale 7 branch managers will be there. So for them, there is a different types of power, sanctioning powers are given. Scale 1 will be very less, scale 7 will be much more higher. Because from scale 1 to reaching scale 7, you need experience and time. So during that experience, you know the framework of the risk management in the bank, you know how risky it will be. So according to that, different sanctioning power is given for each incumbent or each branch manager in different scale. So that is called, and accordingly for industry-wise loan or sector-wise loan, again, a different kind of limit is given of this sector, how much amount can be given, what will be the maximum exposure. Such things are decided by the top management. And they will decide about the best risk-adjusted return on the capital or investment, keeping in view that how much capital has been employed and what should be our risk-adjusted return. So for this purpose, to be in that position, top management position, it requires special skill, which is more oriented towards the control aspect of a business, for which organization need a separate setup that is called risk management department in the head office. Okay, so these are the basic things. So this setup is done, and this setup has got a hierarchy. Hierarchy in the sense from the top to bottom, who are the department heads or what is the hierarchy of these departments and what are their roles. Just briefly, I'll make you understand. So at the top level, the board of directors, they are the top management. Board of directors are there. So the overall responsibility of risk management in the bank lies with the board of directors. What is their role? Their role is they will frame all the policies regarding risk management, all the systems and procedures, all the risk limit, all the circulars, guidelines. They will follow the guidelines of RPI and circulate throughout the bank branches, so that everybody follows the rules and regulations. And after some time, they will review all this mechanism, and they are responsible for reporting the happening which is happening in the bank to higher authorities like RBI and government. So that is their role, board of directors. Second, the next setup is hierarchy. is a risk management committee of the board. So there is a risk management committee. So they are immediately report to board of directors. So basically, what are the policies, procedure, that decision will be taken by the board of directors, but to make it a circularized or to make it happen as like a circular and the guidelines to be issued to different offices in the branch, that will be prepared by this risk management committee. And they are the, also their role is that they should ensure that the risk management process of the bank is conforming to the policy which is made. Risk management policy is made so that everybody is following that. They are also responsible to ensure that the bank has a robust risk management model and all the technological thing or expertise needed for risk management of the bank are with the bank. So they are, that is their role. Next to them is called the committee of senior level executives. So basically their job is implementation of all the things. All the things which are given by board of directors and risk management committee, that has to be implemented in the bank. So their job is to make it happen. Implementation. Their job is to ensure implementation of all the above in consistent manner. So that the business tactics or business objectives of the bank are achieved. And time to time, they will be reviewing this, and after reviewing, they will report it back to RMC. RMC will report it back to board of directors. And at the fourth or lower stage, there is risk management department, or that is the support group. So basically, what is their job? Their job is to, after implementation, they will always have a contact with all the branches and offices of the bank so that they will get all the information from them. Nowadays, it is not required to get that information because it is totally done through system. MIS is there. So their job is to analyze from time to time, analyze entire thing from time to time. They will monitor whether these risk management policies are followed by everybody or not, and they will have to report different things to the next senior level committees. And also, this department, since they are at ground level, they know they have the experience to know what is happening in the market, so they can also examine the effects of the various possible changes in the market variables, and they can recommend that according to this situation, we can change our policy also. So these are basically the 4 levels. Sometimes questions are asked. So you can, if you read this, it is there in the book also. I have explained it. So sometimes questions are asked on any of the level. What is their job? Or it can be asked, whose job is the overall responsibility? Simply you can say this is board of directors. Whose job is implementation of the risk management policy? So you can say whose job is implementation? Which level? Implementation part comes to 3rd level.
Committee of senior level
So such type of questions might be are coming. So if you know this, then easily you can answer. Okay. Now we have almost done the preliminary aspect of our risk management. Now we are entering into risk management. So what are the steps in risk management? How risk management is done in the bank? So the process or steps in risk management are as given 1, 2, 3, 4, 5. First, you have to identify whether there is a risk or not. That have to identify it. Once you identify it, then you can easily measure it. Okay, identification is about what is the probability, what is the impact. Then we get the score. That score is the measurement. This is the loss we might happen. So that is measurement. After measurement is done, third thing is risk pricing. Risk pricing means we know that there might be a loss. So such cases, as we have already discussed earlier, last class, yesterday evening we have discussed high risk loan and low risk loan. We have discussed about that. Due to this high risk loan, there is a high premium. So normally bank charges higher interest for high risk loan. Low risk loan, low rate of interest. So when this pricing comes into the picture, it is nothing but how much interest the bank is going to charge on that loan. So that is the pricing. So according to the measurement, we can decide whether it is falling under high risk or low risk. Accordingly, rate of interest will be decided. As per the policy, rate of interest has been fixed. This risk parameter of this is having this high risk, this is medium risk, this is low risk. So what will be the interest to be charged for that? So according to that, you have to fix the rate of interest for each kind of loan. Then it is a process, risk management, a continuous process. So it has to be continuously monitored and controlled. Who monitors and controls? Which hierarchy in the 1, 2, 3, 4? Which level monitors and controls?
Risk management department.
Normally monitoring, analysis, monitoring and control is normally done by the fourth one, risk management department or support group. Okay. So this is fourth. It's a continuous process that is not. Then fifth one is risk mitigation. Mitigation means how to diffuse it or how to absorb the losses. Mitigate means normally
reduce the risk.
Very good. So how to reduce the risk? So 100 rupees loan you are giving. So there is a risk that 100 rupees will lose. So how we are mitigating? How we are mitigating the risk for a loan of 100 rupees?
We take collateral.
Very good. So we take collateral security. So collateral security is one of the mitigation process. Like this, so many things are there in market risk and credit risk. There are one example is collateral risk. So if you obtain collateral risk, suppose 200 rupees collateral risk, that means you have mitigated the risk by entire 100%, almost 100% risk is mitigated. So risk mitigation means how the risk can be reduced by way of any other method, like collateral security or any other method which is available. Okay, so these are the 5 processes are there. We will discuss this identification, measurement, pricing, and mitigation one by one. Let us see how much we can finish today. Okay. So first is identification. Identification means it is a simple thing that you have to see and assess that how much loss might happen. For that, so this identification is done at each transaction level. Each transaction level. One transaction means one deposit is received, that is one transaction. One loan has been disbursed, that is one transaction. One investment made, that is one transaction. So every transaction level, a risk identification has to be done. Each transaction made during the banking business is called transaction level. So risk identification consists of identifying various risks associated with risk taking at the transaction level, means each transaction, and examining its impact. Impact means how much loss it might be there on the portfolio level and finally arriving at how much capital is required. So there are three things. First, we have to identify at the transaction level by examining its impact. Then we will also examine or assess what might be the loss at the portfolio level. So what is the portfolio level and transaction level? Transaction level means suppose one housing loan you have given. You have got 4,000 branches. 4,000 branches may disburse 5,000 housing loan in a day. So each housing loan is to be considered as a transaction level. Portfolio level means whatever the housing loan as on that date is there in your bank at head office level at a consolidated manner, means total housing loan of your bank is your portfolio level. So why
Sir,
these
once
two?
again.
Once again,
I said transaction level and portfolio level.
Transaction level you understood? Which bank you are from? Which bank you are from?
Sir, Indian Bank.
Indian Bank. Okay. So Indian Bank is giving housing loan?
Yes, sir.
Yes. Your
Yes,
branch
sir.
is also giving housing loan?
Yes, sir.
So if your bank, if your branch disperse one housing loan, that we'll call at a one transaction level.
Yes, sir.
Okay.
Sir, actually, you told 4,000 branches are there and
so
5,000 loans.
So suppose Indian Bank has 3,000 branches. Okay.
Yes, sir.
And one particular day, they have discussed each branch has disbursed one housing loan. That means on that day, 3,000 housing loan has been disbursed by Indian Bank. That means there are 3,000 transaction level of housing loan.
Okay.
Okay. One branch, one loan is given, that is one transaction level. If you give to one person, suppose your branch has given 3 housing loans to 3 persons, A, B, C, that means there are 3 transaction level.
Yes, sir.
Okay. Now portfolio level means from the beginning housing loan is given by your bank till now. So what is the total housing loan portfolio at your head office? That is called portfolio level.
Okay, sir. Okay.
Okay.
Okay, sir.
Now question is why these two levels are required? Why we have to assess the risk at transaction level as well as portfolio level? What is the significance?
At any point of time, that exposure, that portfolio cannot cross that limit fixed by the board.
No, we are not talking about that exposure. We are talking about risk here. This is about risk
weight of housing loan.
No,
risk weight is given.
How much capital required for that portfolio? We have to assess. So that's why that portfolio level you are taking that consolidated manner.
But I told you that for each transaction, calculation of capital is done at transaction level.
Yes, sir.
Calculation of capital is done at transaction level. So why portfolio level is required?
To assess the overall risk weightage in the sector of housing loan.
For provisioning, sir.
Yeah, I'm not getting the satisfactory answer. I'm not getting.
Provisioning purpose, for provisioning purpose.
Sir, risk
returns from the customer.
At the same time, portfolio is going to be changed.
So to analyze the maximum capital.
Sir, yesterday you said that
The transaction level is at branch level.
100 rupees.
NPA to analyze the NPA level.
Sir, risks are managed by portfolio levels, aggregated by portfolio.
To manage the portfolio levels.
Managed by portfolio levels.
If that is so, if risk is managed at portfolio level, then why to measure transaction level?
To measure the impact.
So whatever you are measuring here for
Branch
impact at
level and
transaction level.
overall bank level.
So okay, that I understood, but why? Why both? My question is why both should be done? Why not one? Either transaction level or portfolio level too. Because capital calculation is always done at transaction level, not portfolio level.
Because in some areas, that product may be success. In some areas, that product may not be
The
success.
transaction level is count of cases and to identify RAROC.
There are various types of risky in different branches, sir.
Value and volume.
Because risk is different for
Can be
different
happen at any
transactions.
time.
And amount shows value.
To ensure how much loss happens.
Transaction on that day.
Risk is different for different transactions.
Sir, there would be a
Yes,
mismatch in
different for different
maturity of
dimensions.
transaction level.
See, everybody is throwing the stones in the dark. Everybody is throwing his stone in the darkness. Nothing is hitting. Whatever you are answering is total. Somebody is telling about the provision NPA. Somebody is going. Why you are going that far? We are talking about risk here.
Sir, transaction is on that particular day. So portfolio is going to be vary. Why? Because something might be closing or some repayments are going to be coming. So that's why we have to analyze the portfolio also.
Transaction
So
is
what is the logic? Logic, you are almost, I can say 20% you are coming closer. What is the logic?
Transaction is a branch wise, sir, and portfolio is a full bank wise.
The market
No,
risk.
that I have told you.
For
That I have told.
averaging the per loan.
Where is the average comes?
We need to know cash inflow, cash outflow, sir.
So we need a CD ratio, sir.
See, simple thing I'll tell.
By compare with the deposit and loan.
Sir, what is the risk?
Risk management
decide
is
the risk weight so that overall risk.
Risk management is about risk only. So what is the telling that about risk? Total risk. Okay.
So there are cases where margin is 50% or there may be cases where margin is 10%. So at portfolio level, we have to net off all this.
Margin?
Sir,
why margin is coming to picture? If you are talking about margin, then why not you talk about the security, collateral security?
Yeah, I'm saying that for a 10 lakh rupees loan, there may be two cases. One case is borrower is offering margin of 2 lakhs and another case is borrower is offering margin of 5 lakhs. So in both the cases, the risk weight is different.
No, margin, what is margin? What is you are explaining about margin? What is margin?
Total cost of project is 10 lakhs. So minimum margin required is 1 lakh. There may be cases where borrower has invested it's 2 lakhs, so he's required only 8 lakhs. And there may be cases where borrower has invested is 5 lakhs and he required only 5 lakhs. So in both the cases, risk weight is different. So security coverage is much more.
Risk weight, how risk weight comes into picture is different. How risk weight is different? Which kind of loan you are telling me? Which risk weight is assigned according to the loan type of loan. Risk weight is not different. Suppose you are giving housing loan to 2 persons, X and Y. So in this case, for housing loan, risk weight is same. You are confusing with the risk weight again. That will come to anyway.
Portfolio level, it may decide about our capital requirement.
The premium is varying.
Simple thing, simple logic. You are going very deep. You are complicating yourself. You are going very deep inside. You are
calculate
that much of
the risk. It is very important to analyze.
Please. I am explaining you because I am not getting the right answer. You are
has to make provision or risk weighted. So that aggregate level of portfolio level, they are calculating that to calculate risk weighted asset.
If you stop, then I can explain what is the correct thing. Okay?
The premium, because of the premium.
Yes, sir.
If you stop answering, I can explain what is the correct thing, why it is done. Simple thing. Simple thing. You are forgetting everything you are doing. We are going deep into so many things. We are only here associated with risk taking. How much risk is taken and what is the risk impact of that risk, that is measuring with. Nothing else. We are measuring at two levels. One is at each time a disbursement is made, and on the total aggregate portfolio level, what is risk that is happening. Okay, so now what is the difference? Because capital is always calculated as per risk management policy at transaction level. Capital has to be calculated at transaction level. If that is so, then what is the purpose of calculating the risk on the portfolio level? Basically, that is to arrive at the third step we have discussed, that is called risk pricing. Pricing of the loan has to be decided. Okay. Capital is decided on the transaction. So portfolio level, we are not calculating capital. Capital is calculated as per one loan when it is given. According to one loan, we have to calculate capital. So what is, because pricing has to be done according to the risk. So now, suppose portfolio, suppose in a transaction in a day, suppose on a particular day, total branches of your bank, so they have discussed around say 400 housing loans on a particular day. Say today, 22nd of September, 400 housing loans have been disbursed. Say amount is say, you can say that 4,000 lakh. Say 4,000 lakh has been disbursed. Okay, now according to this, we have to see what is the risk involved in this. Means here, have we taken enough security collateral for each one? We have to assess, and accordingly, we have to assess that, and we'll see what is the risk and what is the impact in each item. Of 400 different transaction level we have. Now, portfolio level means till yesterday, 21st of September, there might be 1,50,000 housing loans already there in the portfolio. Now 400 is added. Out of this 1,500, there might be say 6,000 say 2,600 housing loans are there which are already NPA. So now these 400 housing loans are added. So that means, do you think 400 we have added all will fall NPA? No, it is not going to fall NPA. So when we assess the risk at the transaction level, the risk or the impact may be higher. But when you calculate these things at the aggregate level, ultimately the risk, which was say 100%, say 90% for one thing, when you merge it to the portfolio level, it will automatically come down, maybe coming down to 40% level. So that process of amalgamation or at a portfolio level, when the risk is taken into consideration at a portfolio level, if the transaction level, the risk was higher, it has to come down to lower level. That is called risk diversification. We'll discuss that later on. Just remember that is called risk. So this risk is diversified at portfolio level because there are good housing loans and bad housing loans together. So risk has to come down. So according to that portfolio level, we will see that what will be the aggregate loss after this merger of transaction level with the portfolio. So according to that, we will decide the risk pricing. So for the purpose of risk pricing only, this portfolio level risk examination is required, nothing else. Okay. While explaining risk pricing, I will make you understand how this pricing is done. So that point you will be clear about this. Okay. So now, according to transaction level, we have to calculate the capital and this capital requirement, how much capital is required for one transaction, we have to calculate. So all the transactions made by the bank for the loan, it will be aggregated and accordingly capital has to be calculated and capital to be kept. So that is the process of identification. Okay. Let's see identification, how the risks are identified, what type of risks are there, how they are going to impact. So we can see from a single transaction. From a single transaction, how risk can be identified. I'm just explaining to you this. After this slide, today's class, we will end it. Just focus on it and we'll see. Suppose a branch of your bank has extended a loan of rupees 1 crore for a period of 3 years at, say, MCLR for 4% plus 4%, or say MCLR is 8 means say 12%. Whatever it is, say 12%. MCLR plus 4%, so it is 12%. The loan is to be repaid in the equal quarterly installment, or say EMI, equal monthly installment, not quarterly, with 1 year moratorium period. Is it clear? Is it clear to you?
Yes, sir. Yes,
Simple
sir.
thing.
Yes,
There is
sir.
no confusion. 1 crore loan has been given for a 3 years period by your branch with a interest rate of 12%, which is MCLR for 4%. The loan has to be paid by EMI with 1 year moratorium. That is the thing. Okay. Now, the situation, just visualize the situation that a branch has disbursed this loan. Branch has given this loan. This loan has been disbursed. When a loan is disbursed by the branch, branch is very happy because they have achieved some kind of target. 1 crore achieved, so he can be sure that my RM or regional manager will be happy that I have given this loan. I have taken the risk, given the loan. So he'll be happy. But thing is that at head office level, at your head office level, a single loan, when it is given by a branch, their workload is increased. So in a day, how many branches are dispersing how many loans? You see the workload of head office increases for the fact that each loan given means money is flowing out of the bank. So there is a cash outflow. So cash outflow means you are disbursing cash, you are giving. That means you must have some cash with you. The bank must have cash. Means this is a loan given. So loan is given from the fund of the depositors. Yes or no?
Yes, sir.
So there has to be a depositor fund from which you should have given the loan. Branch does not know about the thing, but head office level, they should be worried whether such deposits are available with us, which are empty, which are not encumbered, so that we can relate to that. If such deposits are not available, then what the head office will do? Because you have already disbursed. What the head office will do? Huh? Borrow. Simply, at the end of the day, how much cash has outflowed, whether that amount of deposit was available with us or not, that they will check. If it is available, fine. Or if it is not available, then that much of amount has to be borrowed from the market to balance this outflow with inflow. Every day it is done by your treasury department or fund management department or treasury department. Every day it is done. So this is situation one. Suppose fortunately the same day, that is called funding of the loan. So arranging of the fund is called funding of the loan. When loan is disbursed, head of his job is to fund that loan, either through the existing deposit or through borrowing. They have to equalize. Asset has to be equal with the liability. Otherwise, that day book will not be closed. Okay. So fortunately, say the funding of the loan is done from a deposit of 1 year of the same amount with the interest rate at 6.25% by a different branch of your bank. Suppose this was disbursed at Chennai and this deposit was received by Delhi branch. So now at least 1 crore deposit has been. So this funding is done. Okay. Suppose this funding was not done. Suppose this was not received by the Delhi branch and your bank is short of fund, but one of your branches disbursed this loan. So what is that risk?
Funding risk, sir.
So basically,
asset liability
risk. No, that is called funding risk.
Funding risk.
Funding. This is simple funding because you have not funded it. Yeah. Because your bank has not funded through the available deposit. So this is a funding risk. So there was no fund available. So basically at that time, what has to be done? Bank has to go to the market to borrow to settle this funding risk. Okay. Now, second thing is that say it has been received by the bank. Bank has already arranged for 1 crore. So funding risk is not there. Now, what will be the next situation where there will be a change? So any change in any of this side, asset or liability side, will bring in a kind of risk. Say the deposit is given for a period of 1 year. Loan is given for a period of 3 years. So funding is done today. So what will happen after 1 year period? After 1 year period, if the depositor does not renew, if it is renewed, then there is no problem. We do not have funding risk. If it is not renewed, then again
we have to go for funding.
Funding risk is there. So you have to look for deposit or you go for
You have to
arrange the fund from the market by borrowing. So what is funding risk? Funding risk is the risk of unanticipated withdrawal of deposit or non-renewal of the deposit, which are the source of lending. When that is not done, that is called funding risk. Clear? It might be possible that before 1 year, the depositor might come and ask for premature payment also. So when there is an unanticipated withdrawal of the deposit or non-renewal of the deposit on maturity, that time funding risk comes into picture. Okay, clear? Now,
yes.
Now see, after the deposit matures, suppose this loan is there, after the deposit is maturing, after 1 year period. So funding is done. But the rate of interest after 1 year may not be the same as 6.25. Either it will be higher or it will be lower. So if the rate of interest is lower, is there any risk for the bank?
Interest rate risk.
Interest rate risk.
No risk.
So if the interest,
no risk.
So currently you are paying 6.25. After renewal, suppose rate of interest has come down to 6. Whether there is a benefit for the bank or it is a loss for the bank.
Benefit for the bank.
So when the rate of interest on renewal is less, then there is no risk. So there will be no risk when it is less. But if on renewal, suppose the rate of interest is 6.50, So what will happen in that
Loss
case?
to the bank.
Loss to the bank.
Last point.
Not loss, because you have to pay more interest, so your margin has come down. The earning from this, earlier your earning was 12 minus 6.25 for first year. So what was this? 5.75.
5.75 is revenue.
5.75 your margin was there. Now 6.50 means it 5.50. So it is reduced by 0.25. So reduction of profitability is a risk business, risk thing, or it is a loss. So that thing is called, when such thing happens, when due to change in the, so this is called gap or mismatch risk. This is called gap or mismatch. What is gap or mismatch risk? This is the risk of gap between asset and liability. Whenever a long-term assets or loans are funded by short-term deposits, and after the maturity of the deposit, when they are renewed, they are repriced at a higher rate than the earlier one, then a gap is caused between the rate of interest of asset and liability. So that risk is called gap or mismatch risk. Please, ध्यान से सुनो, focus on this because MCQs are asked on such risk. Okay, so you have to be very careful because certain things are very mismatching. So you can very good music is coming from somebody. Please keep on. Now
நீங்க க்ளீன் பண்ணுங்க அப்பல என்ன அப்படிதான் பண்ணும் அடண்டாம அவள் கூட சும்மா இருப்பா
Sir, please.
Sir, please make mute to all.
I have already done, still it is happening. What I can do? Okay. Next is, since this is loan has been given, so at any point of time, the borrower may default. Means he will not pay the installment. So when he's defaulting an installment, so first risk is called default risk. We can call it a default risk. Same thing we can call it is a credit risk also, because credit means it is about the loan, where loan installment is defaulted. So default risk and credit risk are same. Third thing is, since the installment is a cash inflow which was supposed to come to the bank, it has not come. That means we have suffered a liquidity problem. Because installment, if it comes, it brings liquidity. So our liquidity has come down because the installment was not received. So we have faced liquidity risk also. Okay. Now, fourth thing is about the fact that each installment was supposed to be received by the bank on a particular time, because its installment is always fixed for a date. On this date, the installment has to be paid. When that time the installment is not paid, so we can also call that this is a time risk. So when one installment is defaulted, there are 4 types of risk which may happen. Clear? Now we'll see. This loan interest is related to or linked to MCLR, whereas this fixed deposit has got fixed interest, fixed rate of interest. This is not changing. This will change. As and when MCLR changes, this rate of interest might change. Loan interest is linked to a floating rate, whereas deposit is a fixed rate. So if the MCLR is further reduced within a period of say 6 months or something, then definitely our margin of income will also differ. It will come to less. So in such cases, due to lowering of MCLR, where the fixed rate of interest does not change for this deposit, we have a reduced income. So that risk is called basis risk. Okay, so basis risk is that risk which occurs due to change of interest rate on asset or liabilities in different magnitude, which may reduce our net interest income. That is called basis risk. Okay, next one is, now this loan repayment is done by EMI. Say EMI every month, EMI is, he is paying say 1 lakh rupees of EMI every month. The borrower is paying. This is not about every month he is paying 1 lakh. So every month we are getting this 1 lakh cash inflow. Now this 1 lakh liquidity or cash inflow which we are getting, definitely this is a fund we are receiving, and this fund has to be again reinvested, or we can give as a loan, or we can make it an investment out of this thing. Now in this loan we were getting a rate of interest of 12%. While 1 lakh is coming, we are supposed to deploy that fund as a loan or investment to earn at least 12%, which was existing here. But if it is lower than 12%, suppose this fund of 1 lakh is given a loan where you are earning 10% or 11%. In such case, this risk will be called as reinvestment risk. Because at the time of reinvestment of the liquidity fund, we are not earning the exact rate of interest which was earned by this loan. Clear? Now, next case is, at any point of time, the depositor may come. The depositor may come to your bank to make premature payment of the deposit, or the borrower may also come to pre-closure of the loan. He will tell that I want to close this loan. I don't want to continue it. Some other bank is giving at a rate of interest which is lower than this. You please take this amount. So at any point of time, depositor might come for premature payment, and there might be pre-closure of the loan also. So when such event happens, Lakshmi Narayana, can you please mute your mic? Lakshmi Narayana, you are not focusing on the classes. Your mic is on. It is very disturbing. See, my request is that when you are not interested in the class, you can leave the class. Do not disturb. 180 people are there, they are listening. For you, one person, why they will suffer? Is this the discipline you are taught in your school and colleges? At least maintain that decorum. No? See, I don't bother about anything. I can take the classes as my thing, and you can do your examination. If such the case, then I'll take the class in that way. Whether you understood or not, that is not my concern. If you do not maintain discipline, then you will have class like that. I am trying my best to explain each and everything, but you are not listening. This talks about the culture and discipline you are taught from the school and colleges. Anyway, so such thing happens whenever this pre-closure and premature payment happens, either in the asset side or the liability side. That risk is called embedded option risk. Embedded option risk. Okay, so these are the different types of risk. I have just explained important risks. There might be 100 types of risks which may come. So I have explained at any point of time for any change in either asset side or liability side, there arises a risk. And that risk has to be taken care of by the bank for managing that risk. So we have known about funding risk. We knew about gap or mismatch risk. What is a default risk, credit risk, time risk, liquidity risk, basis risk, reinvestment risk, embedded option risk. We have explained those things. So any kind of risk comes, if the MCQ comes, they will give you a situation and they will say identify which kind of risk it is. So you can identify that.
Sir, can you repeat reinvestment risk, sir?
Reinvestment means whenever this loan installment is coming, loan installment is, suppose his installment is say 1 lakh per month he is paying. Okay. 1 lakh EMI is paid by the borrower. So you are receiving every month 1 lakh. So this is your cash inflow, or this is the liquid you are receiving, liquidity. So that 1 lakh becomes your fund, because that fund can be utilized for giving fresh loan or making fresh investment. Now this 1 lakh has come from this loan which we were earning 12% interest. So it is logical that when we are investing that 1 lakh fund in a new loan, at least we will try to use that loan where we can get at least 12% or more interest. If we do not get that return from this fund utilization, say loan you have given, you have got 10% interest. That difference is that 2%, it is less than the existing loan's interest. So in such case, this is called a reinvestment risk. Because your fund which is received as EMI has been reinvested at a lower rate than the existing loan. This is just a logical situation. This is not actual. This is only for the fact that if we invest that fund at a same rate of interest, then our earning might be higher. If we invest that at a lower rate of interest, then there is a less earning for us. So less earning is due to this reinvestment risk. Is it clear?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Okay, till now we have completed. So we'll see in our next class, whatever possible, we can discuss. Okay.
Thank you, sir.
Thank you, sir.
Thank you, sir.
The next class onwards, please maintain discipline, because
we have.
I don't think tomorrow we have class or something. I have to check. I don't think tomorrow we have class. Anyway, if class is there, then I'll be there. So
Monday, yes.
Next classes, please maintain discipline, because from the next class, numericals will be explained by me. So if some disturbance comes from any of the student, for which you might not hear the explanation and you will request me again to repeat, I will not repeat. Simple thing. Because in Indian context, unless you punish the other person, they will not be maintaining discipline. Because from the school level, we have been taught that unless we are punished, we will not be following discipline. स्कूल कॉलेज तो हो गया, अभी हम इतना ओके एडल्ट बन गए हैं, फिर भी डिसिप्लिन नहीं मानते. सिंपल थिंग. Simple keeping the mic mute is just a press of button. That also we cannot do. Okay, so I request all of you to maintain that decorum so that peacefully class can be conducted. I can answer all your doubts, which will be helpful to you only. I am not going to appear in the examination. You are going to appear in the examination. Okay, see you in the next class. Good night.
Thank you, sir. Good night, sir.
Good night, sir. Good night, sir.
So,
Thank you, sir. Good